How to time Roth conversions. Hi, I'm Scott Hamilton, certified financial planner, and I help people plan for retirement. So let's say you've worked for decades, you saved dollars into your 401k, your IRA. Let's say you've got $1 million in there. And now you realize you've retired and you've rolled it over to an IRA. And now you realize that it might be better off having some in a after-tax account, a Roth IRA. So, we want to have some assets in your taxable account, some in your qualified, and some after tax in Roth. And I see so many times that retirees come in, we're overloaded in qualified, none in Roth, a little bit in cash. That's typical, very common pattern. So let's define what a Roth conversion is. So you have, let's say, the $1 million in the qualified account that you've moved to an IRA. And now you realize that your RMDs are just going to get escalating over the years. You're going to be in a higher tax bracket, paying more in taxes than you anticipated. So what can you do? Well, Roth conversion is the classic answer. So let's say you take $1 out of the IRA and you move it into that's a distribution. So therefore it's going to count as AGI, adjusted gross income. So it comes out as income, right? So then you move it into a Roth IRA, which means you pay taxes as soon as you move that money out. So it's important to understand the implications of that. So let's talk about some of the issues. The first issue is there's an income surcharge. It's IRMA, the IRMA costs. Now remember, there's a 2-year look back on this, right? And it can be significant. It could be $11,000 for a couple. Look on our website. We got the full table there and explains what IRMA stands for and also what the brackets are. But it's significant. And it's a waterfall, issue number 4. Waterfall, meaning $1 over the next bracket, it could throw you into the higher cost. And it's a significant cost. Like I said, 2-year look back, taxable as AGI, waterfall, and it can be significant. So what's the solution? Well, work with a financial advisor. We can build a model that will show you what the tax impact would be, what the IRMA impact is, so that you can come into this fully armed to make a calculated decision. And in a lot of cases, Roth IRAs, that is the right answer. So maybe what you do is take a smaller conversion and spread it out over a few years, maybe 5 years. Maybe you retire at 65, RMDs are at 70 or 72, 73. So maybe you use that time frame there to take your do the Roth conversions. We do this all the time with retirees. It's a great strategy, but you need to come into it knowing what the impact is going to be. So work with a financial advisor is the short answer. And thank you for taking the time to watch this. Please like, subscribe, and visit our website, Hamilton Financial Planning. Thank you for your time.